All right, so chapter 7 is going to take us into something called accounting for receivables. I like to think of receivables as things that I'm waiting to receive, typically cash. So, when a company allows customers to buy now and pay later, the company's right to collect cash in the future is called an account receivable. Individually, these receivables are typically small and payable within 30 days. When a longer credit term is needed or when the receivable is large, you get a note receivable, and a note is simply a loan. So we have here a situation where the company is providing goods and services, but they're not getting paid right away. This goes to what we discussed previously as accruals, right? Recognized but not realized. The allowance for doubtful accounts, a contra asset account. Now, a contra asset, the word contra means opposite. So, contra asset is the opposite of an asset. So, an asset has a normal debit balance, accounts receivable, or accounts allowance for doubtful accounts, rather, has a normal credit balance. Represents a company's estimate of the amount of uncollectible receivables. Now, you would think that's kind of weird that a company would assume that they weren't going to collect some of their sales, but it happens, and it happens often. To illustrate, assume a company with total accounts receivable of 50 grand estimates that $2,000 of its receivables will not be collected. So in that case, we have accounts receivable 50,000. We have in the allowance account $2,000 that we don't think we're going to get. And the amount that is the difference is called the net realizable value of receivables. In this case, 48 grand. And that's the way it looks on the balance sheet. So what it's telling investors is we're owed 50 grand, but we're probably only going to get 48. Reporting allowance accounts receivable at net realizable value is called the allowance method. It allows accountants to estimate the amount of uncollectible accounts and report it. So we're going to look at year 2 for Allen's tutoring services. First off, Allen's tutoring services wrote off $70 of uncollectible accounts receivable. Now, this is where they actually say, we're not going to get it. So what happens is we take $70 out of allowance for doubtful accounts, so we debit it, and we credit accounts receivable. So we're pulling the invoice out of AR. Now, if you look at the bottom here, the net realizable value before the write-off was 1,000 minus 75 bucks, or 925. The net realizable value after the write-off is the same 925 because we're taking 70 of the 75 bucks and we're also reducing accounts receivable. So we have $5 left in the allowance account. Now, if we have to write off more than that $5, our net realizable value now is going to be reduced. So here's in year 2, we have revenue of $10,000. So as you know, we debit accounts receivable, credit service revenue. That's pretty straightforward. Event number 3, we collected some money. So we collected $8,430 of the accounts receivable, the invoices that we are owed. So we debit cash for $8,430. We credit accounts receivable for $8,430. In event number 4, we're going to recover an uncollectible account. So this is a situation where we wrote off here in this particular situation $70. But the client came back and said, you know what, I can't pay you the 70, but I can give you 10. And of course, $10 is better than nothing. So the first thing we do in reinstating the receivable is put it back in. So we're going to debit accounts receivable for the amount we're going to get paid, which is $10. And we're crediting allowance for doubtful accounts because we don't have to use it. We're getting paid. And then we record the receipt. So we debit cash, credit accounts receivable. And the balance now in the allowance account went from $5, now is up at $15. Now, there's a method called percent of revenue, and that's calculating the uncollectible accounts expense using a percentage of the revenue. So in this case, ATS will recognize 2% of their $10,000 in revenue. So 2% is the estimate for uncollectible accounts. So we're going to recognize $200 as uncollectible accounts expense. So we debit the uncollectible accounts expense account for $200 and we credit allowance for doubtful accounts for $200. Looking at our financial statements for year 2, we had service revenue of 10 grand. We recognized uncollectible accounts expense of $200 against that revenue, leaving us a net income of $9,800. Now notice, accounts receivable is $2,500 at the end of year 2, and the allowance account has $215. Remember, we had $15 left from last year, and we added $200 to that. So $215. So the net realizable value of accounts receivable is $2,500 less $215, or $2,285. Before adjusting its accounts on December 31st, year 1, Pyramid Corporation, different company, had a $56,000 balance in its accounts receivable account and a $500 credit balance in its allowance for doubtful accounts account. Pyramid estimates that 6% of its accounts receivable are uncollectible. Now remember, when we did percent of revenue, we added the balance from the previous year to the uncollectible accounts expense for year 2. We added them together. We're going to be doing something different using a percent of receivables. Pyramid estimates that 6% of their $56,000 balance, or $3,360, will be uncollectible. Now, because we're using accounts receivable, since there was a $500 balance already in the allowance account, we're going to subtract that from the $3,360, and we're going to recognize uncollectible accounts expense for this year of $2,860. So we debit uncollectible accounts expense for $2,860, and we credit allowance for doubtful accounts. Another method is to use a report that I used to use a lot, but for a totally different reason. It's called the aging of accounts receivable. The aging report is really important, especially when you're doing collections. It shows the customer name, excuse me a second, the total balance owed by the customer, and then how is it broken out in days since the invoice date, number of days past due. So we've got $26,500 that's current. There's $11,700 that is between 0 and 30 days old. $13,100 that's 31 to 60. $3,000 61 to 90, and then $1,700 over 90 days. What we can do here is we can look at this schedule and we can say, well, for current receivables, it's likely that we're not going to collect 1%. Or $265. For the 0 to 30 column, we're going to say 5% of those won't get paid. So 5% of 11,700 is 585. For the 31 to 60, it's going to be 10%. For 61 to 90, it's going to be 25% of that 3,000. And over 90 is going to be 50%. So when we extend these out, we come up with $3,760 of uncollectible accounts expense based on the receivables as of December 31st. So the ending balance in the allowance for doubtful accounts account shown must be $3,760. That's what we want in the allowance account. Since Pyramid has an unadjusted $500 balance in its allowance account, we're going to recognize uncollectible expense of $3,260. $3,760 minus $500. Now we're going to look at direct write-off. Now, if uncollectible accounts are not material, generally accepted accounting principles allow companies to account for them using the direct write-off method. And let's go back. Let's remember that the term material is, in an accounting sense, means it's not an amount that would change the opinion of the average investor as to whether or not to invest in the company. I usually use the example of if there were a $100 mistake for a $100 million company, would that make you change your decision as to investing in the company? Probably not. Now, if that were a $10,000 mistake, it's a very different issue, isn't it? That would be material. Under the direct write-off method, a company simply recognizes uncollectible accounts expense. So there's no allowance for doubtful accounts when you're using the direct write-off method. None of that stuff that we were doing before. However, since you're writing it off when it doesn't get collected, it's not being matched with the revenue that's not being collected. It should be matched in the same period where the revenue was earned. That would be GAAP. To illustrate the direct write-off method, return to Allen's Tutoring Services, Year 1. Assume ATS decided the direct write-off method was appropriate. Recall that during the year 1, ATS recognized $3,750 of revenue. So here's the revenue recognition: debit accounts receivable, credit service revenue. In the year 2 accounting period, ATS determined that $70 wasn't going to get collected. That's what we looked at. ATS recognized the uncollectible accounts expense in the entry. So in year 2, they recognized that $70 again, but now there's no allowance for doubtful accounts. So we're debiting uncollectible accounts expense for $70, and we're crediting accounts receivable. It's a direct write-off. In year 2, now we're doing a recovery, and the recovery works pretty much the same way it did before. First, we have to put the receivable back. So we're going to debit accounts receivable for $10, credit uncollectible accounts expense. Remember, there's no allowance account here because we're doing direct write-off. And then we're going to debit cash and credit accounts receivable for $10. We're going to take up notes receivable in part 2.